This was supposed to be a temporary glitch. Then they started allocating more and more money to it and spending more and more time. Now they've taken a step further, and this has gone from the shocking to the ridiculous. They've bumped the term loans from 14 days to some point all the way up to 42 days. We've got 28 days here, 42 days here. We'll put up a table right now. This is the Fed's projections of what they'll be doing in the term repos in the near future. The billions of dollars on this side have stayed relatively consistent. We've got 35 billion, 25. Down here we've got 15, 35, 35, 15, 35, and 35. And what I think is absolutely amazing, if you scroll down to the bottom of this page, you see on the Fed's website, it actually says, there's that little logo that says report a fraud or a scam. How about the Federal Reserve? That's the biggest fraud, the biggest scam I know of. It's crazy, you just can't make this stuff up. Also, I wanted to point it out that if you look in the mainstream media on this, total fail. It's really, really annoying here. You can see this guy's really pissed off. But we Googled the keywords Federal Reserve repo market, and check out what came up in the news section of Google. Not one article talking about the fact that the Fed has upped the term on these repos. I don't know for sure, but if I had to guess, I would say that the reason the Fed is doing all this is because it's a covert operation to paper over or to conceal the insolvency of one of the big banks or multiple banks. So that brings us over to bank insolvency secrets revealed. I've got four main contenders, and I want to go over exactly what makes them potentially insolvent. So first and foremost, we've got HSBC. Number one, they are the perpetrator of mass criminal activity. If you didn't see that, go to my most recent gold ETF video. They just ousted their CEO. Their US business just this year has lost $189 million, and they just laid off 10,000 workers. Definitely not something that a flourishing bank would do. And if you didn't watch that gold ETF video, which you definitely should, they are the custodian of all the gold in the GLD ETF. Our second contender is Deutsche Bank. And let's start off the fun by looking at a chart of their stock price. Editor, let's pull that up. And you can see we could pretty much end it right there, but it gets better, it gets better. In Q3 of this year, they lost 132 million euros. In Q2, they lost 3.15 billion euros. They just cut 18,000 jobs, which was 20% of their workforce. And if this chart wasn't scary enough, let's look at a chart of Lehman Brothers when they went bust. And when you layer over the chart of Deutsche Bank, it looks almost identical. Candidate number 3 is SoftBank, the Japanese tech/private equity fund, one of the largest, if not the largest in the world, at $100 billion assets under management. They are most recently in the news for their WeWork bailout, which is one of the companies that they're heavily invested in. WeWork lost $40 billion in market capital in the span of about 3 weeks. They've not only had massive losses with WeWork, but also Uber and several other companies in their portfolio. What really makes them risky and a candidate for the Fed repo bailout is their business model. Let me walk you through that. What they do is they find an industry in tech, or if you've got a company like this and they've got several competitors most often, and they'll inject billions of dollars into this company. They will just flush them with liquidity, often much more money than they even need. And the reason they'll do that is because they want them to grow really, really fast. So how do they get that growth? Well, their strategy that they employ is to get them to grow by undercutting the price of all of their competitors. Usually they undercut the price so heavily that they have to sell their product or service at a loss. And you may be asking yourself, well, George, that doesn't make sense. How How can that work? They can't just sell things at a loss and make it up in volume. But what they do is they cover these losses with all this excess liquidity that they pump into the business at the beginning. So all of these billions of dollars are going into the company knowing that they're going to get this growth by actually losing and incinerating the investors' money that they put into the fund to begin with. Then if things go as planned, then this company will grow and have monopoly powers. At that time, they'll be able to raise their prices and wipe out their competitors because they'll have that monopoly. And you might be thinking, well, I mean, that might not be that bad. That's kind of what Amazon did, didn't they? And yes and no, but the main point here is that SoftBank is doing it with all these tech businesses that don't have a moat around their business. And in order to have a monopoly, you've got to have some reason why people can't come in and easily compete with you. A great example of that is WeWork. There's no moat around that business. This is really an insane business model, and they've got over $100 billion that's levered up in these type of risky businesses with this crazy, crazy business model. To illustrate my point, let me give you an example of a company that SoftBank has recently invested into. And this is really going to paint the picture for you. This company goes by the name of WAG, and that's why I've got a big W here. You may ask yourself, well, what is WAG? That sounds kind of weird. Is this the next Google or the next Apple? No, I don't think so. This is the new dog walking app. That's right, a dog walking app. And SoftBank just invested $300 million into this fantastic dog walking app. This is why I think SoftBank very well could be the recipient of the Fed repo bailout that we're seeing. Oh, but wait, there is more. Who do you think's investing in these crazy private equity funds like SoftBank? That's right, pension funds, the taxpayer. Number 4 is Santander, and they are one of the largest holders of subprime auto loans in the United States. Let's pull up this chart right now, editor, please. I want to show you the staggering growth in auto loans in the United States over the last 10 years. We're at 1.1 trillion in auto loans right now. One of the things that came out in the news lately is they have been verifying a whopping 3% of their customers' income when they come in for a loan. So 97% of the customers that they come in and actually give a loan to, they don't even verify their income. 4.6% of their entire loan book is 90 days plus late on their payments. 14.5% are just overall late. I want to circle back here and point out this chart that shows that this 90-day delinquency rate on auto loans is really a leading indicator when you take it back to the last recession. Look at the way it started going up in 2005, and you see it kind of peak out and then really crash. But when it starts to go up steeply, if you look at the last recession, that's when we should start to be worried. And that's what it's showing us right now. I want to share with you what Santander does with a lot of the subprime auto loans. We start off with these subprime borrowers out here. They don't have much money and they've got very low credit scores. Santander goes out to these people and says, listen, no income, no problem. We'll still give you an auto loan. So they give the money to these people to buy their cars, and then that loan goes to Santander. That is an asset now that's on their balance sheet, believe it or not, a quote-unquote asset. They take these loans from these people who probably can't pay them back, and they bundle them all together in a package. And this is called an ABS, an asset-backed security. And believe it or not, there's more interest that you can get from the asset-backed securities than the individual loans. Then they take these from their balance sheet, get them off their books by selling these into the market at a premium and pocketing the difference. Who do they sell them to? They sell these investors who are then holding the bag for these subprime borrowers not paying back their loans. So you may be asking yourself, who are these investors? Like who would buy this garbage that Santander is putting out into the market? And honestly, I had the exact same question. So I did some research for about an hour and I couldn't find who buys this stuff. Finally, I came across an article and it all made sense. So who do you think this mystery buyer is that's buying all these asset-backed securities? None other than the pension funds, of course. And that goes back to the taxpayer. These pension funds are so starved of yield because they can't get that 7% that they need. They're going further and further out the risk curve by buying this type of garbage just because it has a little bit higher of a yield. And who is to blame for this? It all goes back to the Federal Reserve and their ZIRP policy, zero interest rate policy, for 10 years. That are taking these pension funds, who are the taxpayers, and pushing them into these risky assets. And I'd like to remind you what was at the bottom of their own website. Report a fraud or scam. The moment you've all been waiting for, the huge announcement is we're doing a repo bailout Twitter poll. So go to my Twitter page, it's at George Gammon, and there you can tell me who you think is the recipient of the Fed's repo bailout. Is it HSBC, the criminal custodian? Is it Deutsche Bank, the derivatives disaster? Is it SoftBank, the kamikaze of capital? Or is it Santander, the sultan of subprime? Go to Twitter right now and let me know what you think. And if you guys want more information just like this, check out this content right here, and I will see you on the next video.